So how does a hotel really know if it's winning? I mean, a no vacancy sign is great, but it can be super misleading. Today, we're going to pull back the curtain on the secret language of the hotel industry, the key performance indicators, or KPIs, that separate the hotels that are just busy from the ones that truly dominate their market. This is how you win the game.
All right, here's how we're going to break this down. First, we'll look at the big performance puzzle. Then, we'll check our own hotel's vital signs, the internal numbers. After that, we'll size up the competition. And finally, we'll get to the metrics that really tell you if you're winning the market. Let's dive in.
And really, this is the big question, right? Full rooms are fantastic, but are you getting the right price for them? Are you actually stealing business from that shiny new hotel down the street? To know for sure, you have to get past the gut feelings and look at the cold, hard data.
Okay, to make all this super clear, let's invent a hotel for our little case study. We'll call it the Grand Explainer. It's a fantastic place, but to run it well, we can't just guess. We need a totally unbiased way to measure how we're doing. We need numbers.
And that's exactly where key performance indicators, KPIs, come into play. The best way to think about them is like vital signs for a business. You know, just like a doctor checks your pulse and blood pressure to see how healthy you are, a good hotel manager uses KPIs to diagnose the health of their business and, more importantly, make smart decisions.
Okay, so the very first step, always, is to look in the mirror. Before we even start worrying about what the other guys are doing, we have to get our own house in order. And we'll do that by looking at 3 absolutely fundamental internal KPIs.
All right, first up, the most basic one, occupancy. This answers the simplest question in the business, how full are we? It's just a percentage that tells you how busy the hotel is, whether you're looking at last night, last week, or the whole year.
The math is super straightforward. At the Grand Explainer, we had 300 rooms available, and we sold 255 of them. That gives us an 85% occupancy. So, 85%. That sounds pretty good, right? And it is, but it tells us absolutely nothing about the price we got for those rooms. And that's the next critical piece of the puzzle.
And that brings us right to our next KPI, average daily rate, or ADR. This number tells us, on average, what people are actually paying to stay in one of our rooms. It's all about the price tag. I mean, you could be 100% full, but if you basically gave the rooms away for $1 a piece, that's not a win.
Okay, so let's look at the Grand Explainer. We brought in a total of 34,425 euros from our rooms, and we sold 255 of them. You just divide one by the other, and bam, an ADR of 135 euros. So the average guest paid 135 euros for their room. And this is where things get really interesting. This brings us to RevPAR. And let me tell you, this is kind of the gold standard for internal metrics. Why? Because it brilliantly combines both of the things we just talked about, how full you are and how much you charge. It answers the real question, how good are we at making money from our entire building? So for us, the math is simple. Our 135 euro ADR multiplied by our 85% occupancy gives us a RevPAR of $114.75. That means, on average, every single room in our hotel, sold or not, made us about $115. But here is the million-dollar question. Is that any good? I mean, is that a win? A loss? The truth is we have no idea. Not yet. Because the only way to know is to stop looking in the mirror and start looking out the window at the competition.
Okay, this is where the real game starts. Because here's the thing. Performance is completely relative. Knowing if you're winning is impossible unless you know who you're playing against. So it's time to size up the competition and ask that all-important question. Are we getting our fair share?
To do that, you need what's called a CUMSET. This is a hand-picked group of your direct rivals, other hotels that are going after the same guests you are. They're similar in quality, in location, in what they offer. You got to be comparing apples to apples here.
All right, check this out. This is the neighborhood for the Grand Explainer. Our hotel has 300 rooms, but if you add up all the rooms from our direct competitors, the total market has 1,136 rooms up for grabs. Our fair market share, or FMS, is just our slice of that pie. In our case, 26.4%. Think of it this way. If everything in the world were perfectly fair, we should get 26.4% of the business.
But, business isn't fair, which is why we measure our actual market share, or AMS. This number isn't about how many rooms exist, it's about how many rooms people actually slept in. It tells us, out of all the guests who stayed in our little market, what percentage of them stayed with us.
Okay, so on this particular night, the entire market, all those hotels combined, sold 800 rooms. We sold 255 of them. Do the math, and that gives us an actual market share of 31.9%. Now hold on. Think back for a second. Our fair share was only 26.4%. This is huge. It means we are absolutely punching above our weight. We captured way more of the actual business than our size says we should have. That's a great sign.
Okay, so now that we have these two key pieces of the puzzle, our share of the supply and our share of the actual demand, we can put them together to create three incredibly powerful index scores. These numbers will tell us with no ambiguity whether we are winning, losing, or just treading water.
First up is the Market Penetration Index, or MPI. This is super simple. It just compares how many guests you actually got versus how many you should have gotten based on your size. Basically, are you getting your fair share of the people?
And the beauty of this score is how simple it is to read. If your MPI is over 1, you're winning. You're getting more guests than you should. If it's exactly 1, you're perfectly fair. And if it's less than 1, your competitors are eating your lunch. For the Grand Explainer, that's our 31.9% divided by our 26.4%, which gives us about 1.21. So yep, we are crushing it when it comes to volume.
But hey, getting bodies in beds is only half the story, right? That's where the Average Rate Index, or ARI, comes in. This one's all about your pricing power. It directly compares your average room rate to the average rate of everyone else in your comp set.
And just like with MPI, reading the score is a piece of cake. An ARI over 1 means you're successfully charging more than the average Joe. Below 1 means you're undercutting them on price. This tells you right away if you're the premium choice on the block or if you're competing on value.
And that brings us to the grand finale, the final boss of KPIs, if you will, the Revenue Generation Index, or RGI. This is the one number to rule them all, because it wraps everything we've talked about, your guest volume and your pricing power, into one powerful score. This tells you if you're truly outperforming the market.
So the market average is always set at a perfect 1.0. That's the baseline. As you can see, our hotel, the Grand Explainer, is at 1.2. What does that mean? It means for every single room in our hotel, empty or full, we are generating 20% more revenue than our average competitor. It's not just a win, it's a clear, dominant victory.
So we have to end here. Knowing you're winning is awesome, but it's not the finish line. It's the starting pistol for the next race. What's the move? Do you get aggressive and push your rates even higher? See if you can grow that ARI? Or do you double down on marketing to steal even more guests from the competition? See, the data doesn't just give you a report card on the past. It hands you a playbook for the future. And that is how you win the game.